All right, we are live on YouTube and LinkedIn, and this is your OZ Sherpa, Ashley Tyson. Really excited today to have John Hyre here on stage with me. John is an attorney. He is a tax attorney. I don't think that he's a reformed attorney yet, but I think he's working on it. He's got some really cool stuff that he's been doing, both inside of the tax world, some stuff that is doing inside of kind of the investment world and tax mitigation world for them. And we're really excited to have him on stage today with his salty self, and hopefully he'll keep it salty. A little bit of a disclaimer. If you are easily offended, I would highly recommend that you stop watching right now. But let me also caveat that the views reflected by Hyre are not necessarily the views of OZ Pros. And so if his saltiness offends you, take it up directly with him. But it's really funny. I kid around, but that's one of the things that I love about him. And we're really excited to have him. It's an honor and a privilege, John, to share the stage with you. Welcome, and give us a little bit of background. Tell us where you're from, what you're doing, and what you're excited about.
Yeah, grew up in Ohio to the extent I grew up at all. Moved to Puerto Rico almost.
That's definitely a questionable. That remains to be seen as to whether you have grown up.
There's some honesty there, right? There's some self-awareness. Grew up somewhat in Ohio. Moved to Puerto Rico about 7 years ago because no U.S. federal income tax. I pay a local tax rate that's advertised as 4%, and probably right now averages out to 6% for me. So I'm pretty darn good with that, and we like it here. I mean, my wife and I are complete opposites. I married a Chilean. She's a Latin female artist, and she does stuff. And I say to her, that thing you just did, that's a Latin female artist thing to do. And she says, well, I am a Latin female artist. And I'm like, that's no excuse. So she likes Puerto Rico because it's not Ohio. It's warm. They speak sort of Spanish. I mean, Puerto Rican Spanish is a different thing. Basically, take Spanish, take a machine gun, put it on cocaine, and take out every fifth round of the belt, and that's Puerto Rican Spanish compared to normal Spanish. And so I don't order at drive-thrus here, because I mean, I grew up speaking Spanish, but I still don't order at a drive-thru because I don't know what I'm going to get.
It's all so number one, ordering at a drive-thru is questionable anywhere. Number two, it's definitely questionable in Puerto Rico, and then you have the language difference. So I think that there's all kinds of issues associated with ordering at drive-thrus in general, but certainly down there in Puerto Rico.
Yeah, so it could be I just stay home and possibly, I don't know, drink? Because they're
I sense a theme there.
Yeah.
All right, so I know that we're going to get questions. Walk us through your wall of bourbon. I do see some good ones up there in the background, right? That green box of Blanton's, that's kind of exciting.
Yeah, we did, I guess it's a vertical. We did the green, the black, the regular Blanton's, a store pick, the gold, the red, which you see on my far left, and then the straight from the barrel. And the straight from the barrel, we did 120.2 proof and 134.6 proof, just to compare the difference between the same whiskey, but at very different proofs. Granted, Everybody was pretty hammered at the end, but the difference between the Blantons was amazing. We did a tasting for charity where that really went over well. The Weller 12s, I just came back from France with 9 or 10 of them. They're like $55 over there. Well, 60 because the euro is up some right now. I'll tell you one that's underestimated. This one right here. This is Jim Beam, their brand called Hardin's Creek. It's 15 to 17 year. It is fantastic. They absolutely knocked it out of the park.
So Jim Beam and fantastic in the same sentence would probably not resonate with most people because most people have flashbacks to Jim Beam and they're like, "Ooh, man, bad college night." Yes.
Yeah, no, that's those Jim Beam. Actually, in general, I would say Jim Beam, once it hits 12 to 17 years, like the Knob Creek 12 year, I think for the money, that's a hell of a drink. So there's
all right. So if you now know that if you want to get to John Hyre's heart, bring him some kind of crazy bottle of bourbon.
There you
I
go.
got a couple bottles back here. I quit drinking, and so we've talked about from my collection what I'm going to be bringing him, but I know that he's always a taker.
Hey, I'm happy
Hopefully he
to.
hasn't been drinking yet today, but we'll see.
No, I intentionally don't drink before these. I figured let's get sloppy during. Actually, one of the things I've done as I've gotten older, and I measure it. I got 2 watches, right? Nothing says autism like 2 data watches. I just need an Aura ring to
You can borrow mine.
yeah, kind of round it out. But there's a consistent, like I ask myself in the morning, how do I feel? And
Yep.
how many hours did I sleep? And I usually now can tell what this little device is going to say. I'll tell you this, man, if I drink alcohol after 5 o'clock,
Yeah.
I feel it. Even just like I normally drink 2 ounces of bourbon a day. That's my ration. Like in the
Yep.
British Navy, they have their grog ration. I got
Yep.
my bourbon ration. But if it's after 5, man,
So
then I'm not avoiding.
is a little bit over a shot, right?
It's a good sized shot. A normal shot is 1 to 1.5 ounces. So 2 is a little bit higher than that. And here's what happens. If I have bourbon after any alcohol, really, after 5 o'clock, I don't save as much taxes the next day. And that's very disgusting to me. You know, it interferes with your sleep. Your brain's a little off, just a touch groggy. And I can tell, man, it makes a difference. Nobody warned me about this when I was 20 something.
Well, it wasn't the same way. That's one of that. I mean, that's basically the reason why I stopped drinking was because, man, it made me feel terrible. And I noticed that it slowed me down significantly. So I was like, all right, yeah, I'm just done with it.
Yeah. Well, I'm happy. I'm happy to help you be healthy. I'm a giver.
There we go. Right. You can offload some of my bourbon.
Yeah.
All right. So tell us what we're talking about today. I know you always have some really exciting stuff. You've got kind of new and interesting takes on some things that have been out there for a while. But whenever I am in a room with you, I always pick up something new that I hadn't thought about before. That's
you're
one of
going
the
to love
reasons
this.
why I love interacting with you. And so tell us what you're going to hit today.
Today, we're going to get into 2 things. The new Trump accounts, which I'm sure once the Democrats win, they'll be called commie accounts or whatever. I mean, they'll change the name to it. But for now, they're Trump accounts. Let's see what they change them to. And we're going to get into rollover business startups, ROBs, which, by the way, you're going to like this, Ashley, because in Puerto Rico, I pay my 4 to 6% rate. But when I do something outside of Puerto Rico in the States, I need a different entity because Puerto Rico has no jurisdiction there. I use rollover business startups, but I'm going to give you a hint. What you see online and what I'm going to show you are very different.
Completely different. All right. You ready for your slides?
Yeah, let's do it.
All right.
You're my Vanna.
I am your Vanna White. And we already had a conversation about how my legs can't compare, but that's okay.
Is this a family program or can I say slide bitch?
if that's the worst that comes out of your mouth today.
Yeah, that's kind of mellow, right?
I think we're going to be okay.
All right, so let's go ahead and hit the next slide. Yeah, real briefly, this is not professional advice. That's what happens when you pay a qualified legal, accounting, tax professional to look at your situation and render capital A advice. This ain't it. This is education. It's great education. We'll leave some time for Q&A, so there will be some back and forth. But if you do this on your own, you try this at home and you're too cheap to go get proper financial advice, tax advice, whatever it is, you will probably win a financial Darwin Award. You will lose money. And frankly, I will laugh at you. I will mock you ruthlessly. I think, Ashley, we agree that we love people who DIY because we get paid so much more to fix what they do than we would have gotten paid to do it.
The unscrewing fee is like, usually it's like 10x what I would have charged on the front end to just set it up right.
But humans.
Yes.
Yeah, this time will be different.
Yep. Oh, yeah, exactly. Oh, you know what? It'll be okay because I won't screw it up this time, right? Like, surely I will figure it out based upon, the 10-minute video. Actually, they usually don't even watch the 10-minute video. They just grab something, right, that they've downloaded, or they let AI generate it for them.
Oh, yeah, AI is great. Oh,
yeah.
We should do a whole webinar on what to ask AI and what just don't bother.
Yeah.
I mean, we both played with that.
And what comes out relative to you're gonna have to tell me when to move.
Yeah, go ahead and hit the next one. And real briefly, I'm a tax lawyer. I do a lot with self-directed accounts. I do a lot with real estate. That's how we got together. In fact, I started out doing OZs until they got too complicated. Because what happened with OZs and me, if Ashley, you remember, because you're the one I asked a question and your answer blew me away. And I'm like, I need to stop doing OZs. In the beginning, they were simpler.
Yep.
For me, what did it? I'm good at partnership law, subchapter K.
Yep.
I'm good at OZs. But when you put them together, there is an exponential increase in complexity. And I started missing some of those nuances. And I don't like that. I don't want to, mess anything up for a client. So I just kind of backed off on it. And that's one of the things I know enough when we're looking at a client situation, when an OZ might make sense for them, and I send them to you.
Yeah.
That's one of the things I don't do. But for the audience, what I do, I've been to tax court. I've got a good record there. I've only lost once so far. It was only $7,000. And it was because the guy didn't have what he said he had. He said he had the paperwork. He didn't. So I go to tax court. I do a ton of research. I present. I practice. I used to do returns. We sold that practice, but I'm involved in a return practice now, so we can talk maybe later. And we'll get into, whenever, Ashley, you feel like it, the September event I'm doing, where it's 3 days of advanced planning strategies. In fact, what you're seeing are sort of the beta slides, the test slides for parts of it. We're going to spend a lot of time on rollover business startups, much more than we will today. Today's kind of a warm-up exercise, and I will talk about the Trump accounts there, but it's going to be 3 days of hyper advanced stuff. And so we'll at some point talk about that. Trump accounts.
Well, hold on. Let's hit your event that you're having in Atlanta real fast. And I had a slide for this. I've been trying to get it up on stage. I can't do it. Just give us the dates for it. And then I'm going to put the banner in here for people to be able to sign up on the banner. And then we're also going to have a QR code at the end. So if you want to sign up, you'll be able to hit the QR code at the end of the slides. And then, you'll be able to register for the event that way. You can also register or set a call via what I'm going to roll and what we're going to roll on what's rolling on the ticker right now. So tell us about the September event.
3 days, September 26th to 28th. You can be in person or virtual. In person, the networking's much better. We're expecting a room of about 200. I would say half the room. What happened is it used to be advanced real estate investors, and then we started getting note investors, then we started getting self-directed IRA investors, then just regular small business. But we go so deep and sophisticated, even though I don't offer CPE, one day I'll take the trouble to go get it. We get a bunch of CPAs who show up in spite of the fact we don't offer it because they take notes for their clients. So we get CFPs, CPAs.
And it's September 26th through the 28th, correct?
Yeah, Friday to Sunday at the Airport Marriott in Atlanta. And the room block is still good. I think it was like $100 a night, which is not bad for a Marriott. So what are we going to cover there? We have a number of speakers, including Ashley. We're going to get into some specialized topics. 3 of the ones I want to go deep into will be the ROBs. You're going to see some of that today, the rollover business startup. We're going to get into private money lending, both inside and outside of IRAs. For example, oddly, I don't normally put assets that generate rentals, interest, dividends, royalties, or cap gains in an S corporation. But we're going to talk about why I like private money lending or hard money lending out of an S corporation. And I'll give you a hint. You can qualify the lending for the QBI deduction. And that's an extra 20%. Actually, it's more like 25% off on your taxes. Because I did research. If you lend in a certain way, it's considered a trade or business. That's really important for QBI. And I know that sounds like to the rest of you, savings. We'll go into
Charlie Brown teacher effect.
Yeah, we'll go into detail on just these little angles we find. We're also going to get into taxation of farming. So those are 3 deep topics. We're going to hit a bunch of topics just like Trump accounts. We're going to spend probably 15, maybe 20 minutes on that. Just depends on how long it goes. We have a just shotgun of lots of excellent topics. It'll be definitely heavily self-directed IRA focused because that's where a lot of the savings are. Be some real estate discussion. We'll of course have a cost segregation guy there. You can't have a planning conference without a cost seg guy.
Yeah, it's such a layup that yes, you definitely need to have him there.
And here's the important part. I got taken. I had my own practice. I shut it down. I worked for an outfit, a tax firm that we can get into later on. Now, they took me basically as of counsel, and I'm a shareholder, a partner in the firm. And I just make this stuff up and consult and train the staff and that sort of thing. So I'm not really available to hire directly personally the way I used to be. The reason I'm doing this event is my people, my list, my following, like to see me once or twice. Well, they like to see me more than that, but it's their time.
Sure.
I would say 40% of the event will be Q&A and discussion. Now, the Q&A will be sorted based on usefulness because you'll get one guy in the corner who has a 30-minute question on this obscure Lord knows what, and that we can't have that. That's just too much.
I don't know
bandwidth.
anything about that.
Yeah,
I don't know
right.
anything about the people
Yeah.
that are like,
You probably
and,
even know the same
yeah.
people. I have AI facial recognition tech that knows who some of these people are. They're just not allowed into the event. But there's going to be a bunch of back and forth, and it gets salty. My daughter's job there is literally to heckle.
That's good.
And she's good at it. She is
good at it.
humor.
Holy cow.
Yeah,
well, she learned from the best, man. But
yeah.
between you and your wife, good night. Yeah, she didn't have any choice.
Yeah.
I can only imagine growing up in that household.
Woof. Well, we actually had 7 kids. 3 survived. The other 4, we believe at least one of the other 4 was eaten by one of the others. We're not sure who did the deed.
Still trying to figure that one out, right?
So yeah, so it's the 26th to 28th, Atlanta, virtual, in person, advanced planning, lots of Q&A. We will save you a ton of money. We always do. It's an event I've been doing now for that particular event. I think I've been doing that since 17, so only like 8 years or so.
Yeah.
But cool. Let's get into the Trump accounts.
All right. While you're getting fired up for that, just let me give general housekeeping. If you've got any questions or comments, drop them into the chat. We've got it to where if you put a comment up there and it doesn't suck, then I will pull it onto stage and we'll answer it real time, and we'll hit it like while we're talking about the specific topics. So if you've got questions, you've got comments, drop them into the chat. If you just want to heckle Hyre, do that as well.
Oh, that's totally welcome, especially
absolutely.
The commies they're not really good at heckling. Like they only really do well when there's a lot of them. They're anonymous, like you're on Facebook or Reddit.
Newsom's been trying to lately, but I don't know, man. It's fallen flat. The Democrats are like, oh man, look at Newsom taking it to him, and I'm like, dude, that guy.
Yeah, if that's all you got.
Yeah, exactly.
Oh dear. So yeah, it's what happens when you get a California guy trying to act like he's hetero. It just doesn't go over well. So there go the California people. Watch the drop-offs on the whole thing.
Yeah, exactly.
Yeah, we warned you. Hey, for those of you in California who are one of us behind enemy lines, we feel for you. We hope your family moves so you can escape. That's #1 tax planning move. We'll just start with get out of California.
It definitely is a good start, but we've got lots of strategies if you are for whatever reason, and I do understand the weather, kind of, right? I certainly wouldn't make that decision, but I can get it. Why some people would be like, listen, man, I got to stay here. There is something to 75 degrees and sunny and no bugs, right, on the water. And so God bless them. We got strategies for you too. All right, tell us about Trump accounts, man.
So Trump accounts took a little while to figure out. They're still going to change some. Some of the language when they drafted this was a little bit messy, so I think some clarity will still come. And the good news is we have until July 4th of next year that's when you can start contributing. So what is a Trump account? I summarized it up top. And this is a good geek summary. So for the normies, we'll break it down. Don't worry. But it's essentially a high basis, meaning you contribute to it after tax. So converting to Roth is really easy. It's a high basis, segregated traditional IRA. Why is it important that it's segregated? Because I'm a racist. No, wait, that's not it. Wrong. It's segregated from the other IRAs so that you can convert only it to Roth. Because normally when you have a bunch of IRAs, traditionals, you have to lump them together to convert to Roth. And without going into the math and the mechanics, that can become very expensive. And so they actually make it high basis, segregated. It acts like a traditional IRA, but it's forced to invest in certain index funds. It can't self-direct it until later. You don't need any compensation to contribute.
Of course you can only invest in certain index funds because why wouldn't we want to make it so that you can only get Wall Street richer?
Now, it was certain donors, all right? Like this, as much as I dislike this administration, much less than I dislike the last one, they've got donors and they clearly cater to them. Why is TikTok still around? Some donor. So anyway, don't even get me started. Up too late. So the nice thing about these accounts, you can contribute to them without compensation. To contribute to a 401k, an IRA, you have to have compensation. Basically, that means salary. That's the short form of it. Here, you can have kids under 18. In fact, once you hit 18, you can no longer contribute to these. You can have the parents, the grandparents, a friend, pretty much anyone put $5,000 a year into one of these for kids 1 to 17. The year you turn 18 is the first year you're not allowed to contribute, the year you turn 18. So what is it? It's a way to create an IRA for kids without them actually having to work. Now, if you pay your kids, that's a legit strategy if it's done right, like anything else in the code, if it's done right. You can pay your kids and actually have them have traditional IRAs, Roth IRAs, in some weird cases, 401ks. But this is for the people who just don't have that ability or want to add this on. So again, Trump accounts are for people under 18. They can put $5,000 a year in. They don't have to show compensation from a job in order to do it. It has high basis, meaning the parents or whoever contributes does not get a tax deduction for putting money in. But the good news, what that means is the account is high basis. So when you convert, when the kid turns 18, one of the strategies is you can convert it to a Roth IRA, and it's very cheap. There's not much tax hit because the only part the kid pays tax on the convert is the income. What does it earn? So you add up all the contributions, then you look at the total value when they hit 18. Whatever the difference is, you're taxable on the conversion of the difference, the income that you earned between the contributions and when they finally converted, which makes it really easy for them to convert. My goal, since we're so into self-directed and because it's so powerful, and especially Roth, without spending a ton of time, Roth is infinitely superior to traditional, especially in a high inflation environment, because you're taxed on nominal gains. And in an inflationary environment, gains are higher, but some of that's fake. It's inflation, and you're still taxed on it. So I really like Roth, especially if you're into alternative investing. If you're pulling 12% or more a year, Roth in terms of return, even if you're in a high bracket, Roth is a no-brainer. So I like this because the high basis. The other strategy with this being high basis is they can pull out money when they're 18 and pay very little tax on it. We'll get on the last slide too. We get around the pull up. There's a 10% penalty for pulling things out of these accounts.
You want me to go to the next one?
59 and a half. Oh, okay, got to move along.
No. I was just saying, I didn't know if you wanted me to go to the next slide.
Oh, okay. No.
I'll be a good Vanna.
It's at the end. I skip around a bunch. The other strategy, so you have a high basis account. When the kids hit 18, they can convert it to it doesn't have to be self-directed. I do think it should be. They can convert it to a Roth IRA very cheaply, given how the tax mechanics work. In my case, my kids will convert, or my kids are too old, my grandkids would convert over to self-directed Roth. The other approach is they can just pull the money out for certain life events that are not heavily taxed. They have medical issues. They have an emergency. They have $1,000 emergency provision. There are a bunch of things we'll go through at the end that if you don't want to convert to Roth, the kids can pull out the money for that and be taxed very lightly. So it allows you to start saving earlier in life and allow the kids to see it, $5,000 a year. And okay, next slide.
All
right, so you can open it January 1st of 2026, but you can't contribute to it until July 4th of 2026. I don't see the point of opening it too much sooner. In fact, I've been talking to custodians, because for IRA custodians, this is great. They're already geared to set stuff like this up. Plus, they're going to want the business of people converting over to Roth IRA when they hit 18, and they want the kids locked into their brand from when they're young. So the custodians are very excited about this. They're still figuring it out. They're still figuring out how to contribute to it. Now, I'd note the contribution deadline, unlike an IRA or a health savings account or a Coverdale educational savings account, is December 31st. You don't have the extended deadline to April 15th, so you do have to contribute during the year. The problem is, the only thing I really don't like about it is all you can invest in are certain stock indices. They're not self-directed. Now, once you hit 18, you can change it. Again, no contribution for putting money in, but that's why the withdrawals are mostly tax-free, or the conversion to Roth is mostly tax-free, but you have to watch out that there's a penalty. If you pull money out, converting it's not a problem. But if you pull money out before you're 59 and a half, there's a 10% early withdrawal penalty. Now, if you take a look, there are exceptions to that. We'll go through that in the last slide. So it converts automatically to a traditional IRA when the kid hits 18. And then I would say just add a step and convert to Roth. I do make a note here. Take a look at the sub-bullet point. One of the advantages is it's a segregated account. Just trust me, when you have a high basis traditional account, without going through all the math, you want to keep it segregated. It makes converting it to Roth much cheaper. If you decide to mix it, when this converts to a traditional IRA at age 18, you're going to save money. See the air quotes for those of you who aren't looking.
So you would convert it prior to them turning 18 when it converts to a traditional?
When they hit 18, the year they turn 18, it automatically converts to traditional.
Okay. So and then if it converts to a traditional, then do you have to pool them all together or not?
You don't want to pull them together.
Yeah, okay.
Because with the benefit of it being segregated is you maintain the high basis. And that means converting to Roth is very cheap. If you pull it with your other stuff, odds are very high you're going to have a much lower basis, and converting to Roth now becomes much more expensive because when you pull it, they average out the basis.
Sure.
And so you're going to drop your average. So the fact that it's segregated, they knew what they were doing when they put that provision in there.
Sure.
So it's basically kids with a social security number. This was Trump's way. You're going to see a lot of this. Like the funds you invest in are America.
Yeah.
Those funds, not foreign, America. You'll see they're trying to figure out how to build America index funds. The kids need a SOCH. And this comes from, actually, I don't know if you remember this, years ago, the refundable child tax credit. If you had an I-10, so illegal immigrants who had 15 kids in some other country were legally, there were news reports on this, they were legally getting refunds. So it was a refundable credit, meaning a handout for the rest of you. Like the politicians call it a refundable credit. It's a handout. I paid zero tax. I have $1,000 credit. Normally you wouldn't get any refund, but if it's a refundable credit, you get $1,000 check. What do we call that? A handout. And so there were news stories running of if there wasn't a social security number, it was okay. They would still take an I-10. So the illegals were stacking their look, and I would do the same. If you give me the incentive as an illegal of free money,
sure, of course you're going to do that. Yeah, of course. So an I-10 is an individual taxpayer identification number.
Yeah.
And so anybody can get it, whether you're an illegal alien, whether you're a trust. It's just basically a way that you can have a number with the IRS. And so to John's point, it didn't matter, right? So this whole like birthright citizenship, all that kind of stuff didn't come into play. It was basically like if you had somebody, you could create an I-10 and then get this refundable tax credit. It was also a way for people, like there was tons of fraud around it too, because people were creating I-10 for people that didn't exist.
A lot of extra kids out there.
Yes, exactly right.
And then so they get around that here. They say social security number, which means you're probably a citizen if you got a SOCH.
Yeah.
Also, take a look at the last piece there. Government does the seed funding of $1,000. If the kids are born in 25 through 28, the government sets up the account for them and puts $1,000 in to start it.
That's crazy.
Automatic. Little kids making money from day one.
Well, you know what? I mean, it really makes sense, right? Because if you think about the growth of that, over the next 65 years and they don't touch it, I mean, it's kind of like setting up a life insurance, policy for your kids when they're born, right? You can either buy that cheesy, ridiculously overpriced crib, or you can put that into an account and actually fund a retirement plan for them. All right, we got our first comment. And because we got our first comment, I'm definitely bringing it on stage. Kind of applicable, kind of not. But I'm like, listen, I want to encourage the comments coming in. So I'm pulling it on stage. Terry, thank you.
And it's a great question. He's taking care of a slide for me because one of the provisions is that businesses in general, before I answer the specific question, can contribute $2,500 to the employee's kids, or if the employee's young enough, straight to the kids' account. So here's the idea people are having. My business is going to contribute $2,500 to my kid's account. I'm going to get a write-off, and the kid gets $2,500 in the account. And it's a great thought. I had the same thought. What's the problem? Discrimination rules. Without going deeply into it, Ashley, you're familiar with some of the 401k anti-discrimination rules.
Yep.
That if you own a certain amount of the company, you're excluded from doing this. Or if too much of the deduction is going towards the kids. But basically, I did the research on because the problem with the code is it has like 15 different anti-discrimination requirements. I did research the one in question. You won't be able to contribute if your kids are involved. This is really for employees, and you're just doing it because you love your employees and not your kids, and you're contributing to their kids' accounts, but not to yours. Now, you do get a deduction, and if you want to keep good people and you want to pay them extra, this might be a way to do it. But in terms of contributing to your own kids' accounts, it's not going to work. You're going to be able to do $5,000 a year, you or relatives or friends. And by the way, let's skip to the other question, because it also says that nonprofits can contribute. Nonprofits. And so my initial thought was, if you have a private foundation, you can use and there's no limit. The nonprofits.
You want me to go to the next slide, or?
Oh, it's in there. I'm just answering slides ahead of time.
All right. Yeah.
He read our mind, so I'm like, screw it, let's talk about it.
All right, man. All right. So we got. Well, I pulled a question up, and now all of a sudden everybody's on here. It's also an incentive for families to have children, which should help with declining birth rates.
Yeah, there's been studies on how subsidies don't really help with that. Hungary is the one that's tried the hardest, and they're dying. I was just there, and trust me, they're still dying out. They're not a happy people. Poland has some pronatal policies and so on. I would say overall, improving relations between the sexes and not teaching crazy woke shit that makes people not want to get married. on top of, I thought you'd like that one. On top of just a good economy where people can make enough. But there's also a cultural, it's a whole separate discussion. There's a cultural phenomenon that the younger generations, they think they have it really bad. And I ask them, which year would you like to be born in before the year you were born in? Like, I would gladly not have been born in 1970. Things are way better now, but they don't see it.
I mean, like mind-blowingly better. I do, like, both of us remember growing up in the 80s.
Look, remember when we were kids what a starter home was. Nowadays, they're like, well, I can't have a starter home of 2,500 square feet after I traveled Europe for 5 years as my gap years in my 20s, drinking $6 lattes. Then I just can't afford kids. And I'm like, no, you can't afford your lifestyle. You can afford kids. But that's just don't even get, well, I was going to say don't get me started, but clearly we did. Let's go to the next slide.
It's good stuff. All right.
So this is the employer contribution. They can put in $2,500, and there it is. Section 129D prohibits discrimination against normal employees in favor of highly compensated employees. So if you don't have any normal employees, because by definition, the highly compensated definition for this code section, because again, it varies throughout the code, that definition. Yep. Here, owners are just called highly compensated employees, even if they don't in fact make a lot. So you have to be able to provide it to more normal employees than to highly compensated employees. Like if you've got 9 non-highly compensated employees, whatever that definition is, and just 1 for your kid, great. But if more of this is going to the kids of highly compensated employees, and there are really 2 metrics, that's an owner, and then there's an earnings threshold. If too much is going to those people, it's just not going to work. Because the first thought I had when I saw this was, cool, I'll have my S Corp pay this to my kids.
Sure.
And I look this up and I'm like, 129D takes away the fun. Now, if you're going to provide your employees, you got a bunch of normie employees, and you want to provide them with this just because, then you might as well benefit. But is this something you would do just in order to have tax savings? Is this an employee benefit you would provide just to have tax savings? No, because it's by definition, the way they structured it on purpose, you're paying way more out in order to get some benefit.
Yep.
So it doesn't make sense from the employer standpoint. Let's do the next slide.
Yeah, unless to your point earlier, you're looking for ways to get money to them on a tax advantage basis.
Yeah.
The problem with that is that most employees just don't factor it in. They're like, oh, thanks, but that's not comp.
Yeah, actually, some of them hold it against you. It's superior because they don't pay tax on it. You get a tax deduction. This goes in the kids' account. They don't pay tax on it. So as if it were pre-tax money to them, and they still don't appreciate it. They're like, well, no, I can't go buy beer with it today.
And that's all that, I mean, it's wacky. It's like, hey, that didn't hit my account, so it doesn't exist.
Private foundation, and I was seeing posts online on, of course, like, oh my God, on TikTok, that if you have a private foundation, it can put unlimited amounts of money, $1 million into your kid's account. Oh my God, it's just awesome. Oh, TikTok, the Chinese are killing us. You're killing me, Smalls. You're killing me. So the problem with private foundations is there are self-dealing rules. For those of you familiar with prohibited transactions in IRAs and 401ks, it's a very similar set of rules, very similar, that you're basically not allowed to use the private foundation to benefit owners. And I use the term owners loosely because technically a foundation doesn't have owners, but I use it loosely because I don't want to explain the actual terms. If you're related to the foundation, if you donate to the foundation, if you set up the foundation, It really can't donate to your kids. That would be a prohibited transaction. What it really is meant to, the way it was set up was for large foundations and governments, whether it's a tribal government, a local government, a township, a
That
state,
makes sense.
and you
Tribal
pick a
government.
category of recipients, like all 7-year-olds in this zip code, or all 7 to 18-year-olds in this zip code. And it could be the Ford Foundation, which would only donate if they think the kids are going to become little Marxists. And it could be the schools. Well, same thing, actually. Why be redundant? So it's really designed for the very large nonprofits to put money into these accounts in the geographical area. So I was excited until I read the fine print, and then it was very disappointing. Next slide.
All right.
All right. So the first strategy, we talked about it. What are you really going to do? You're going to convert the number one strategy. What would I do with it? You have a high basis. It becomes a traditional IRA when they hit 18, but it's high basis, which means the cost of converting to Roth is low. I would convert it to self-directed Roth. The day they hit the year, they're going to turn 18. So not the day they turn 18, whatever year they're going to turn 18, January 2nd, maybe the 3rd, once we're done drinking and the hangover's gone away, I would convert it over to Roth, make it self-directed. And if you think about it, if you go down to the second to last bullet point, if you start when they're born and you go till they're 17, it's 90 grand contributions plus inflation adjustment, because it's going to go up every year from 5,000 based on the inflation adjustment, plus whatever income you earn. Now, it is stock indices, so Lord knows what's going to happen with the stock market. For me, that's the only real downside. I don't like the stock market, but it's a good way to start, and you can self-direct when they're 18. It doesn't even have to be you who does it. I mean, the basic rule for who can contribute, someone who likes the kid. That's it. I mean, they're pretty loose on that. You don't get a deduction for doing it. That's the key.
Yep.
Let's do the next one.
I mean, it is actually kind of amazing, right? So like when I first looked at I skimmed a lot of the other stuff in the one big beautiful bill. It didn't have it to do with opportunity zones. So I saw it in there, but I really didn't pay a whole lot of attention. But I'm like, holy cow, this is actually legit.
All right, strategy number 2, you can do distributions. The problem is because the kid is under 59 and a half, distributions are stuck in the 10% penalty ground. So it still could be tax-free or low tax, but you throw in the 10% penalty. And it's not either or. Could you convert some to Roth IRA and distribute some for various uses when they're young? Sure. Let's hit the next slide. If you go on to ChatGPT, it does a pretty good job of going through, and let's kill education. That shouldn't have been there. I didn't edit that out. That's for IRAs, not 401ks. I got to go through and edit that a little bit. I just noticed that you can make distributions from accounts for certain reasons and not pay the 10% penalty. And I thought I would go through some of them here. Now, there are some that are more rare. I just thought I would put the ones here that struck me as pertinent. And so, but if you double check, this is one of the things. Chat's good at some things and not good at others.
Yep.
This is very mechanical. If you ask it, what can an IRA distribute without paying the 10% penalty, even though you're under 59 and a half, it does a pretty good job of sorting through a list. So if you figure the kid's not paying a 10% penalty, let's say it's for education, they're 19, and they want to make a distribution they're going to pay very little tax on, they can use that for college. So it just depends on what's going on in their lives. For example, $5,000.
I love the $1,000 emergency, self-certification. I mean, that's great. That's Dave Ramsey special right there. Because how many people in America don't have $1,000 for emergencies? Bam.
Look at the last one. Your kid joins the military as a reservist. They get called up for active duty. They let you hit the account penalty free.
Huh.
I like that. I like that.
22,000 if you're in a federally declared disaster recovery. That's impressive.
Yeah.
Huh. That would have been everybody during COVID.
Yeah, seriously.
Right. We got another comment.
Another
question here. Can multiple people contribute, i.e. grandparents, aunts and uncles, and etc.?
Oh yeah, they can. Yeah, but you can't go past the $5,000 a year.
All right. No matter how many people
do 1,000, but it's got to add up to 5,000, not more.
Okay.
So that's it on these. Now we're going to do Rob's. I can tell you right now we're going to go over because this was the easy, fun one. Rob, Ashley, we're going over. Dude, I'm going to tell you what. I will bet you money you end up using this.
You know what? I'm all over it. And inside of it too, I also got a question for you about a solo 401k Roth conversion. Uh, and whether I can take some of my solo 401k, hit it into a Roth, and then use that in a Robs. So let's hit it. Let's go, man.
But spoiler alert. Hello. So what is I'll tell you what he spoiled here in a minute. It's just Ashley. He can't help himself. Dude, you know why you stopped drinking? Because you don't need to anymore. You just do you without assistance now. You've been on the planet long enough. You do you well. So
Yep.
what's a rollover business startup? For me, it's the most important tax break outside of moving to Puerto Rico. Now this was geared a little towards real estate people. So I'm going to go through that, but also to just normal humans. So this is especially good in real estate for flippers and wholesalers. But in general, if you're a service provider, which Ashley and I both are service providers, this applies to you. If you sell a bunch of inventory, I don't care what it is, right? Houses are inventory. This alcohol behind me, I suppose if I got the proper licenses, could be inventory. Whatever it is you sell, if you sell a bunch of something or you provide services, a rollover business startup may be a way for you to pay a 21% tax rate and then dump most of the money into a Roth 401k. Let me repeat that. You have a business. It makes $1 million. It pays 20%. I'm rounding down a little for the ease of math instead of 21%. It pays 21 or 20% tax. So there's 80 grand left over from this business you ran. Most of that 80 grand can go directly into your Roth 401k. It can go directly into your Roth 401k. And I'll give an example in a minute, but that's the benefit. If you're already making enough money that you're living fine, this is a machine by which you take 21% tax, which for some of you, 21% is a lot lower than what you're paying.
That's a dream for most people.
There's a bracket arbitrage, and that's not even the big benefit. That's the little benefit. Oh, instead of 37% top bracket, you pay 21%, 41% reduction in tax. That's the little benefit.
I'm going to be asking spoiler questions all the time because I think that you're probably going to hit this. Could you set up your Robs in a different state and then be able to suck it out and only pay 21%, not have to pay state tax?
Now you get in the state situs issues. Where was the service performed?
Yep.
Yeah. So for example, that's why when I perform services in Puerto Rico, Puerto Rican law applies. But when I perform services in Georgia, Georgia law applies.
Sure.
So no, it won't do that for you. Now let me tell you before I go into an example that illustrates. This is the spoiler. The second bullet point Ashley already spoiled. Look this up online. It's TMI and Gigo. The vast majority of Robs online are two things: franchises and traditional. And they're not self-directed. They're invested in the market. So franchises, traditional 401ks, which is insanity. We'll get into the numbers. It's lunacy. And they invest in the market. They're not self-directed. And there's not much detail out on the internet about prohibited transactions in Robs. One of the problems with Robs is there are very few self-directed IRA, self-directed 401k tax attorneys. There just aren't very many.
Nope.
There are even fewer Robs attorneys who also understand Roth self-directed accounts, including the prohibited transaction rules and the UBIT rules. So if you go online, I just want you to understand, you're getting the handicapped lame version. You're getting the one that's traditional and can't self-direct. So you go to Guidant and you pay them $5,000 and they sell you the template that's traditional and you invest in the market. And great, if that's what you want to do. But it's not there. It's so much better. There's a reason Ashley, at the first question out of his mouth, what was it? Can I Roth this? Can I do this with Roth? That is the only way to do it. Let's go through the numbers. Next slide. All right. This is my situation. That most of the time, what is a rollover business startup, a Robs? There are three people involved. Ooh, menage a trois, a little bit less family-oriented show now. So we have a C Corp that usually owns, so there's a C Corp. It's 98% owned, not always, but usually, by a Roth 401k.
Yep.
And 2% owned by a human or a lawyer, whichever. And so let's walk through, because I
usually mutually exclusive.
C Corporation, 98% owned by a Roth 401k, 2% by me. First of all, it is exempt from many prohibited transactions. In most retirement accounts, you're not allowed to work for the account at all, no services, even if they're free. You're not allowed to pay yourself a W-2. You can in a Robs. In a Robs, You are supposed to work for the C Corp. You are supposed to pay a W-2. It's the opposite. You actually have to, based on how the statute is written.
Okay.
And then guaranteeing personal loans. In most IRA 401k arrangements, if you guarantee a loan personally on behalf of the account, it's a prohibited transaction. And without going into the penalties, there's a reason they call it a prohibited transaction. Bad, don't do it. But in a ROBS, you can guarantee the loan personally. For example, the SBA will lend in this structure. Remember, a C Corp owned 98% by a Roth 401k, 2% by you. The SBA will lend to the C Corp, and they will allow you to personally guarantee. So let me give you an example. I make $1 million speaking in the US, not in Puerto Rico. I mean, Puerto Rico is US, so I should have put the states. I make $1 million speaking or providing services or whatever it is I do in the States. Now, how much did it take me to fund that? Am I very capital intensive?
I got you actually are pretty expensive, dude, right? Like all that
I have
you gotta buy.
So
it's literally plane tickets and hotels.
Yeah, a service business is not that expensive. Here's what I do for optics. I like to put 50 grand in. One of the things I do when I do planning, I've litigated enough that I have a sense of how IRS agents and IRS lawyers think.
Yep.
And I want to make whatever we do, if possible, if it's not too burdensome, something that is unattractive to them.
Sure.
Or something that does not catch their eye. If you put 3,000, let's say I only need $3,000 for this, like legitimately, it's all I need. And then I make $1 million in year one. Does that look kind of funny?
Yeah, it's like that's like the dude. Is it Sailor that put in $2,000 into his Roth?
Peter Thiel.
Peter Thiel, yeah.
And the statute of limitations passed on him. They know about it now. So I put in 50 grand. Why? When an agent audits it, if they see how much you put in, 50 grand, even if they make a lot, it just seems more substantive. It's good optics. Like, do you have to put in 50 grand? No. But do I like the optics of it? Yeah.
Now can you have that 50 grand making money while it's in there?
Oh, yeah.
Yeah. Okay.
Yeah, it's not going to sit there.
Yeah. Okay.
And then the next year, I'm just going to distribute whatever money I don't need. So if I only need 10,000 of capital reserve, I'm going to distribute the excess 40,000 plus whatever I made. So let's say I make $1 million. Yeah, well, 98 too. You always do it pro rata.
Yep.
I make $1 million speaking in the US. I pay 21% federal income tax. So the corporation now has 790,000. That, by the way, again, is the secondary benefit. Like Ashley is excited about paying 21%. That's not the big benefit. That's just a bonus.
Yep.
That's great. That's nice. Here's the big one. Take a look at bullet point number 5. That's where it's really at. I distribute 774 to the Roth 401k tax-free, right? Because when I do a dividend from the C Corp up to the Roth 401k, there's no tax. So what just happened to my Roth 401k in 1 year? It went up to 774. I converted my services income, or for those of you who sell stuff, I don't care what it is you sell, your sales income or your services income, you get taxed once at 21% federally. Then you jam 98% of it into the Roth. When will that be taxed again? At the earliest, 10 years after you die. Your kids inherit, they're tax-free for at least 10 years, maybe more. So you're taxed once at 21%. You take this money and jam it, most of it, 98% of it, what if you did this every year in a Roth? What if you did? I am jamming money into my Roth 401k whenever I work in the States. And it's just getting huge. Yep. This is the way to do it. And this is not something you see online very much. This is the benefit. So my distribution to me is only 16,000. Yep. So I do pay the dividend tax. I am double taxed on that 2%. Again, the last bullet point is really the bottom line here. This applies to you flipping houses, you're assigning, like I said, any service business that's fungible. What do I mean by that? Ashley and I have different clients. Can I have an S Corp and a ROPS? And I put some clients in the S Corp and I put some clients in the ROPS. Yeah, I've actually looked up the case law on that year. This was like 20 years ago. I looked this up, that you don't have substance over form rules for entities. Entities by definition are form based, meaning I can do what I want. I can put clients in whichever one I want.
What
Now,
about?
let me interrupt in 1 sec. Let me give you the other counterpoint.
Okay.
Let's say you have a dental office. You can't do that because
Nope.
the dental office has a bunch of equipment and employees.
That are
That's
servicing all of the clients.
Yeah, that's a unitary business. It's not
Yep.
what I call a fungible or severable business. Having a bunch of clients like you and I do, you can pick where you put them. That's severable. It's fungible. But if you've got a dental practice or a factory, that's unitary. It's all or nothing. That is in one entity. And now, no, could you put the next dental practice in a ROBS, assuming you can get around the licensing issues? We'll get into that in another slide. What if you have other losses? Would you have to pay the 21%? Well, if the C Corp has losses, I mean, if you have losses, they don't help the C Corp,
No.
right? Because you and the C Corp are different people. And so if the C Corp has losses, I mean, the C Corp uses deductions just like anybody else. So if it generates losses or deductions, yeah, you don't have to worry about the 21%.
All right. So, and I guess that could be a question too. Well, this is my question. So could you do this? Could you set this up and then kind of play it out over the course of the year, see how much you're going to make, and then pay a management fee over to the ROBS? Or does it have to be clients?
No, okay. I don't like management. First, in general, just in general, I don't like consulting or management fees because it's usually bullshit. There's a lot of case law where unless you can show you actually managed and you have proof that the management fees you charged are commensurate with the actual management, which nobody does that. When people do management fees, let me tell you what it means to me. When I see a tax return with management or consulting fees, here's what I read. I wanted to move money once in a bullshit fashion that I cannot back up in an audit. And so, and the IRS knows that. The agents look for that. And so I don't like the management fees. Plus, you get into prohibited transaction issues. Like ROBS are more prohibited transaction durable, that you can do some things in a ROBS that would be a prohibited transaction elsewhere, but the rules are still relevant. And one of the primary prohibited transaction rules is your ROBS should not really be doing business with you. Now, there are exceptions. I have signed off on, for example, some people renting property to their ROBS. The ROBS owns a business and they have a beautiful commercial location and they charge it below market rent. That's really important. They charge it below market rent. It's aggressive. It's aggressive.
Wait, so you shouldn't be doing the Augusta rule out of your ROBS?
Actually, you could. No, see, so the rule on compensation in a ROBS, now let me think about it. Augusta rule, you have to undercharge
your own house.
I agree. I don't really like the Augusta rule.
I think that might be a little bit.
No, you're right. You're right. I don't really like Augusta in a ROBS. The compensation, how high can it be? Now, I want mine low. I already make enough money outside my ROBS. I don't need to jack it for salary. So I like to keep my salary low.
Yeah.
But what's the highest you can charge? Well, you do a salary study. There's really good software out there. It's RC Reports. And if you get an accountant who has that, they run this salary study software. They usually charge you $500 to $1,000 on what's a reasonable salary range, including benefits.
Yep.
And if you want to pay towards the top of the range, just don't go over. If you pay more than reasonable salary from a ROBS to you, now you have a prohibited transaction.
Well, the whole point of this, I mean, that's dumb, right? Because the whole point of this is to freaking stuff as much as you can into your Roth, right? So, and this is a question too from Tia. Can a regular Roth own the business, or does it have to be a Roth 401k?
It has to be a Roth 401k.
It's got to be a 401k.
Yeah.
Okay.
And it's just because, I mean, the rules, we could go through it, but you would fall asleep. Like even you, Ashley, you would have a big bruise.
Oh man, yeah. Dude, like I'm already fighting it.
Yeah, I know.
and I'm going to save a lot of money, right? So, you start talking about ERISA stuff and I'm like, oh God.
Oh no, ERISA, we hire other people to do. How many don't play that game?
I'm just saying that 401k kind of borderlines on ERISA to me. And so
no, there's ERISA implications. Like, look, everything with great power comes great responsibility.
Sure.
These accounts are powerful, but there are some complicated rules you have to master. But if you think about the value of, you don't need the money, so why pay tax on it and jacking up your Roth 401k? It's crazy that the net present value on those numbers. So can a C Corp be 100% owned by the ROBS? No. And the short version of that is there's something called the plan asset regulations that help protect us from prohibited transactions. Plan asset regs do not apply to 100% owned. That's why we do 2%. Now, if you're greedy, you could do like 95.5%. I think that's silly. I like that. Look, the value of this is so high. I'm not going to screw around with 1%. I'm going to protect this. So I like the 2% number. I've seen some done at 1%. I just think in terms of optics, it's pushing it.
So
I
that's
want
the
the
reason
plan
why
asset.
you put it in there at 2.
Yeah, I want the plan asset regs to apply. They protect me. And if it's 100% owned, those regs don't apply. Let's do the next slide.
All right.
So it's pictures. We'll start blowing through these. This is what I just said. So there's your Roth 401k. Look at that 98%.
Yep.
There's Hyre 2%. Look here, the C Corp makes $1 million. It takes 21%, 210. There's 790 left. Next slide. The C Corp distributes how much? I rounded a little. 774 to the Roth 401k, 16 grand to Hyre. All right, couple thoughts. What's the problem with ROBs? If you have employees anywhere in your structure, this gets complicated. I'm not going to go through this in depth. There are workarounds, there are costs. If there's enough upside in terms of savings, it's worth doing it even if you have employees. But if you have employees not in the ROBs anywhere, because people are like, here's this magical solution for all taxpayers. I'm going to set up a new LLC and it solves all my problems. I don't have to worry about employees because the new LLC doesn't have any. I get more dates on a Saturday night. My wife doesn't know about them because it's a Nevada LLC and so it's anonymous. All this crazy stuff people do with these companies. Now, the IRS looks at all of your businesses, all of your entities, and they look to see, do you have employees anywhere?
Yep.
And if you do, we have to do an analysis. It doesn't mean you can't do this. It becomes more complicated. We take a look and see, I'm looking especially at companies that are 80% or greater ownership on your part, directly or indirectly. So for example, your wife's ownership, your husband's ownership, that counts as you.
Yep.
You have to offer the employees a chance to do this. Now, the classic approach is set this up for a new business before there's any employees. You set it up, then you shut off the C corporation taking any more stock. Then you hire employees. Then you don't have to offer it to them.
Really? Okay.
Yeah. So you set up the business.
Yep.
Before you hire, you set it up as a ROBS. You don't have to offer it to employees because you don't have any. Then you hire. Now, even if you do that, it's still more complicated because you're no longer able to use a solo 401k. If you don't have employees anywhere,
yeah,
ROBS uses a solo K, which is
so that's
cheap,
what I've got.
easy.
Yeah. So I've got a solo
cheap and
K
easy.
and I could convert to Roth and then use that to be the owner of the ROBs.
You got it.
Yeah.
You got it.
I tell you what though, man, like literally you hire one employee and man, it blows the whole thing to smithereens.
Well, no, it just changes the costs. You're looking in terms of, you'd have to set up what's called a self-directed 401k safe harbor plan.
Yep.
And the cost on that is going to be, $5,000 to $25,000 a year. Plus you have to contribute to the employees' W-2s. That's where you have to do the math. Like if you have 3 or 4 employees, who cares? If you have 200, okay, contributing 3 to 4% to everybody's 401k, if there's 3 to 4% of their salary, gets expensive. So now we have math to do. How much is the upside? We just had somebody who's setting up an AI company they think is going to churn out 10 million a year starting next year. And they've got like 4 employees and they were bitching about paying 10 grand a year. I'm like, are you high?
Can we invest in that?
It's trade-offs. You got to look at the benefit and you got to look at the cost. And so if you have employees, you can't exclude them if you already have them, especially if you have a company that owns 80% or more. Ashley, you know what I'm getting into here. It's the controlled group rules. Yep. I don't want to go over it with normies. I don't even want to go over it with tax people. It's a complicated set of rules. I just want on your radar that if you have employees, they complicate things. It doesn't mean you can't do it. It means you have to measure costs. And there are ways to do it. For example, you have to, if you have employees, you have to let them participate. But you can't do bullet point number 4, the anti-Godfather offer. I'm going to make you an offer that you're going to refuse. You can't do that. Now, what you do is you are required by ERISA.
Well, it's actually pretty good, by the way. Just try out Marlon Brando. It's good.
I grew up in Youngstown. It's mob town.
It really is mob town. It's crazy how mobbed up Youngstown is.
Youngstown thinks it's the Sopranos, not without reason.
Yes.
So what happens, though, is ERISA, the retirement law that's designed to protect employees, requires you to scare the shit out of them. You got to give them a notice. You got to tell them you're eligible to invest your 401k in my new business. And then you're required to put this huge list of
all of the risk factors.
Yeah, this shit could blow up in your face. You could lose all your money.
There could be a nuclear war, and and you will lose all of the money that you invest.
Yeah. So that tends to keep them out of it. It just depends on the nature of the business. The more employees, the more complexity. I want you aware of that. I don't want to get into the details, especially since we're going over time. Let's hit the next one.
All right.
So the steps too. You create the C Corp. You create, and by the way, just pay a decent lawyer. It's a normal C Corp. You don't have to have a fancy special C Corp, but pay a decent local lawyer. This is worth a lot of money. What's the net present value of what I gave you in my example, the $1 million a year? It's some stupid like 20, 40 million net present value. It's some crazy number. Don't go cheap and like, I'm going to go on LegalZoom and set up a C Corp. Just pay the local lawyer $1,500. Don't be stupid, and set up a legitimate C Corp and have actual meeting minutes and all of that kind of stuff, the bylaws, the resolutions that you need.
I used to do these a lot when I was doing mergers and acquisitions. So I'd have people that were coming out of corporate America that were trying to buy a company, and the only money they had was money that was in their 401k. And so they wanted to use that as the down payment. And so they'd roll it over, and then they'd drop it in, and then they'd create a C Corp to do it. And I can't remember there was a national group that was doing this. And it's funny is that their documents look a lot like our documents. And, we ought to get into this business, right? Like we ought to just repurpose our software and direct it at this, but we're not doing that yet. And so to John's point, just freaking hire a lawyer. If you need a lawyer, we got plenty we can recommend you to.
Yeah. And look, this is a commodity. It's like $1,500 for a lawyer to do it. They're going to comply with local law. They're going to set up nice resolutions. What's your time worth? Like, I'm smart enough to figure it out. I'm going to spend $10,000 worth of my time figuring out how to properly set up a C Corp, or more likely, I'll spend $1,500 of my time and I'm going to do a crap job. That's what I've seen a lot of. Like Jay Adkison is a well-known asset protection writer, and he says more than 80% of small businesses could easily be pierced in court.
Sure.
He's dead right. He is dead right. So do this right. There's too much money involved. You create a C Corp, then you create a custom 401k. It is sponsored by the C Corp. Now, the only way to fund it is to roll traditional money from any account and then convert to Roth, or roll Roth money from a 401k. If you have an existing Roth 401k, roll over to this. Or if you have traditional accounts of pretty much any kind, roll the traditional money and then convert. They have to be aware that not all accounts roll. For example, under law, Roth IRA accounts cannot roll into a 401k. So you can't use Roth IRA money to fund one of these. Likewise, let's say you work at a W-2 job and you're under 59 and a half. You can't move money from your W-2 job 401k into one of these. There are exceptions I won't get into, but it's pretty rare that you can take money from a W-2 401k, just a normal job that you've got, or even you own a company, but there's a bunch of employees, you sponsor a 401k plan. You're going to have a hard time rolling that money over. Now, sometimes there are workarounds. If you own a company with employees and it's got a 401k, what happens is you take the 401k at your existing place, you set the new one up here, and then you merge them. And that's a way for the money to be available to fund the Roth. So again, there's a lot of detail involved. There are a lot of nuances. I want you to understand the basics, which is, why do they call it a Roth? It's a rollover. How do you fund it? Rollover. No, John, I don't want to roll over money. I've got cash in the bank. I'm going to fund it with that. No, you're not. You have the only way to fund it. No, John, I'm going to set up a new 401k and then I'm going to contribute to it. And then I'm going to do, no, you're not. They call it a rollover business startup for a reason. You're rolling over money from an eligible account, most traditional accounts, or a Roth 401k or a combination. Then you convert to Roth. Then what happens? The new 401k buys 98% of the C Corp that sponsored it. Now, that would normally be a prohibited transaction, but there's a code section that says, except when you do it this way. I talked about the minimum suggested, 50 grand. That's optics. It doesn't have to be 50. I just like the optics. Existing accounts, existing plans, IRAs, 401ks, et cetera, may need extra money. You may not have enough. We get that a lot. Somebody wants to do this, and I'm like, how much do you have in your IRA? Nothing. How much you got in your soul? I don't have one. But I want to have Rob's now. And sometimes we can do it. Sometimes, like they have an S corp, they don't have employees. We set up a solo K. We max out the contributions. We have them contribute to a traditional IRA. And if they're married, then the spouse makes the contributions, and it kind of works out. So again, it just gets complicated when you don't have this money.
So Terry's got the question, can you roll both traditional and Roth 401k and split them in the balance sheet?
Oh, yeah. Yeah, you just have to have a decent bookkeeping software. And by the way, we're going to get into this at the event. There's this guy who's showing up to the event. He's a genius. I teach you how to drive 401ks and IRAs. I'm really into self-directed and what to do with them. So it's like a car. I teach you how to drive it. This dude knows how to build it. He builds the plans. He created this software that makes what Terry just suggested really easy.
Huh.
He wrote some sick software. He and I got introduced. His name was JP Ruiz. And there was an outfit, an IRA custodian that wanted us to meet, but they didn't want to tell us because he's a wild dude. He's fun on stage.
Yeah.
So they had me come in from the left side of the stage, not knowing he was coming in from the right side and vice versa. You know, I'm kind of like, who the fuck are you? And he's like, oh, I'm JP Ruiz. I'm like, John Hyre. We've heard of each other.
Uh-huh.
So we just started riffing and going. That dude is crazy smart. He is a piece of work. And he is going to be at the event for all 3 days.
Awesome.
And he does do ROBs. He does the simpler ones. If you want an employee ROBs, the safe harbor one, we got to find you someone. But he will set up the solo ROBs for you and much more besides. That dude's off the charts. Next
so
step.
So if you didn't have enough in your Roth or your solo or any of the other IRAs, that's not prohibited transaction to loan money into it.
It depends. There are moving parts and details. I have to know. I mean,
okay.
Yeah, there are situations where you can borrow and then roll over with borrowed money and you pay UBIT or not. You have to track it.
Okay.
You can't lend the money yourself though.
Okay. That's what I thought. All right.
All right. So here's what it looks like. You form the C Corp. Next slide. Yep. Then it has a bouncing baby 401k with nothing in it. Yep. Here's how you're allowed to fund the 401k, like not a Roth IRA. It could be these other accounts. And then you can put a little caveat down by the 401k on the right-hand side towards the bottom that if it's a 401k that has employees, you may not be able to roll the money over. If it's solo, you can roll it. If it has employees and you control it, you can roll it. But if it's a W-2 job, I work at Microsoft, I have a 401k, you won't be using that money for a ROBS. It's just not allowed. Next one. And there's your result. This should look familiar in the beginning. Yep. Back in the beginning, this is what we're shooting for. Next one. So some nuances. I don't like it. A lot of people are like, so I got rentals and I set up a ROBS to manage my rentals. No, I don't like the incestuous stuff. Now, sometimes I let people do it. I had a soap manufacturer who sells massive amounts of soap and set up in his ROBS, he set up a custom brand of soap. And I did allow him to buy soap from the manufacturer, which was him, but we did it on certain terms. And there is a certain risk. That is not a risk-free area, what he was doing. But It made so much sense. And I said, look, as long as you're not screwing the 401k, that's what the IRS and Department of Labor look for the most, is the 401k getting a good deal. If you're screwing it, like I'm double charging it for the soap, I charge double what I charge normal clients. They're not going to like that. Now you're taking advantage, just like they don't like if you pay a salary that is what? Too high. The law here is gray. ROBs have been around. People have been doing this since the 80s. They didn't call it that. This is just a brand name.
Sure.
There's been no there's no case law. In terms of the written law, like the IRS has put out 2 white papers with a grand total of, 7 or 8 pages.
Yep.
This is very gray, but in a good way.
Sure, because it allows you lots of flexibility that way.
Yeah.
Very similar to the opportunity zones right now, right? Is that we don't have a whole lot of case law. We've got a crap ton of regs, but yeah. All right, so Doug asks, am I required to contribute every year? I'm assuming that what he's talking about is there a way to make it so that I can make it that I don't have to run it through here if I'm not making money? I'm assuming that that's what he's talking
Yeah,
about.
yeah. You don't have to. No, you don't have to contribute every year. Now, what I do like to see are periodic contributions, just to keep it alive, as it were.
Yep.
But you can have, it can be a dead one. Here's where I get bent out of shape. When people continue a 401k after they've left the job, that can be a little gray. They have the same 401k from the same job. It could be their company. I tell them, listen, they have a huge solo.
Yep.
That's, I don't have a real problem with. But let's say they have a 401k from an old job. At some point, the IRS could say, if you don't contribute to it, is this really still a 401k?
Yep.
You should roll it over into something that's living.
Is it really an IRA?
Yeah.
Yep.
Well, an IRA, you can get away with not contributing to an IRA. The difference is it's individual.
Sure.
And it's not company. But you don't have to contribute to it. You can go a long time without contributing. I just like once in a blue moon, even a small contribution, like $1,000 or something, just to show it's still got a heartbeat.
All right. That actually, it's funny is that that's actually, I guess, the question right here on the next slide. Doug, you beat us to it.
So, well, this is distributions. Remember, there are two ways to fill the 401k. I contribute to it like I do at work.
Yep.
Here we're talking about the C corporation. When does it make distributions to its owners? How much of it should you distribute?
Yep.
Now, distributions are one way. Once the C corp distributes to the 401k, it's very difficult for the 401k to put the money back in the C corp. It's not impossible, but it's difficult. So you should really think about, before you distribute from the C corp to the 401k, what do I want to use the money for? Here's what it boils down to. If you want to invest in more stuff that provides services or sales, I want to go buy a Dairy Queen. Oh, what does that do? It sells a bunch of stuff. You're going to buy a Dairy Queen. Where should you own it? In the C corp. Because if you own it in the 401k, there's this tax called UBIT, unrelated business income tax. It's 37% instead of 21%. So if I'm going to do something, if I'm going to invest the money that the C corporation made in something else that does services or sells goods, keep the money in the C corporation. It's taxed more lightly there. On the other hand, if you're going to invest in more normal investment things, rentals, Bitcoin, stock, oil and gas rights, that kind of stuff, private money lending, you're going to want to distribute the money from the C corp to the owners and do the investing in the 401k. Yep. For the tax geeks out there, the question is, if you were to do it in the 401k, would it generate UBIT? If the answer is no, do it in the 401k. If the answer is yes, keep the money in the C corp.
Yep. All right.
Next slide. Parallel S corp and ROBs. We kind of talked about it. Like when you have clients, Ashley.
Yep.
You can have some clients in the ROBs and some in the S corp. And you do the S corp until you're what? In the 21% bracket. And this is your money you eat with. And this is the money that's going to be just reinvested. You're not going to eat with. So you can have parallel siloed structures if it's the nature of the business to do that. Again, with a dental practice or a factory, not so much. With clients or flipping houses, oh yeah, I can choose which entity they go into. Does that make sense?
Yeah. So it's kind of, I guess kind of to the earlier question, if, I know what I'm going to, I know kind of a dollar threshold that gets me to that 21%, then I can shift it over into the ROBs, for the remaining part of the year.
Yeah. If you have that flexibility, like I said, some businesses you don't.
Okay. I make a 1.2 million net income flipping. I run 200,000 via S corp. That is enough to live on and puts in a much lower tax bracket, which allows me to qualify for all sorts of tax and non-tax benefits.
Yeah. For example, being in a lower bracket, it's not just tax benefits. It's also on the FAFSA and student aid.
I was just going to say the same thing, right? So if you shift it over to where all of the income's coming in it's owned by the ROBs at this point, all of that cash is just going into the account. Holy crap. You could actually get your, you could get your FAFSA down to where it's actually reasonable, where you're actually going to get some aid.
Dude, how about in the States, and it varies by court and jurisdiction. If you're divorced, how about in a state where they only look at what hits your 1040?
Yeah.
ROBs isn't touching your 1040
at all.
In a state where they're not looking at anything that's off 1040, That thing's skating.
Huh. Interesting. All right. Now that's actually really interesting because now the question is when could you do this? I guess you could, well, like mid-year, you just have to start the cash at that point in time, going into
Well,
the
it
rock.
depends on the kind of business. Like, for example, if you have clients, you're kind of guessing. I'm going to
Yeah.
put these 20 clients in the S Corp and these 60 clients in the ROBS. But the numbers are what the numbers are, right? Each client generates what they generate.
Yeah.
What you don't want to be doing is moving clients in between them.
Yeah.
Now, with the flippers, it's easy. They flip in the S Corp for the year until they made what they wanted to make. And the
Yep.
next flip goes in the ROBS. They have
Sure.
ultimate flexibility. Ultimate
Well,
flexibility.
and we could do the same thing, right? We could put new clients into the ROBS. Is there anything that you could do, right? So we're in August now, right? Like, and so I'm just thinking about this for myself relative to getting my FAFSA down.
Told you you would.
Yeah, of course I would. Is there a way that I could go back and grab cash from earlier in the year and put it in now?
No,
I didn't think so.
This is, you got to ask. But yeah, no McFly. No Back to the Future McFly.
That's good. Hey, that's just it. If you don't ask, you don't get.
No,
so I
you
gotta
gotta
ask. I know
gotta
somebody's thinking it. All right. So I run $1 million via the ROBS. That income's tax only 20%. And more importantly, supersizes my tax-free Raw 401k. So this is also the interesting thing is that, via this, you can then pay yourself too. So to your point about the S Corp, drag in enough in order to be able to live, but then be able to shift it over to the other one and then only pay yourself via your, pay yourself a reasonable salary.
Yeah. Yeah. And that's the thing is you figure out the boundaries of the salary. What's the lowest salary? What's the highest salary for the ROBS? And you go with the lowest one, but maybe 1 year you need extra money. You can crank the salary up some.
Yep.
Some. You gotta be careful with that.
What about, and I'm asking this for a friend. Can you make a loan out of the ROBS to yourself if you need cash?
No, because you're using 401k assets indirectly for personal benefit. That is exactly the last thing you should ever do.
All right,
and I know
that's why I was asking
for that reason.
I was asking for that dirty friend that,
The filthy bastard.
Yeah.
It's the difference. Right. It's the one who drinks. It's not you.
It's not me. It's my it's that evil twin.
Yeah.
All right.
And we've gone through this. This is a divisible business.
Okay, yep.
Divisible. Now, with licensing, let's talk about that because we get this a lot. It depends how serious your licensing people are. Like if you're a doctor, the licensing's rough, you want to get permission. How do you get permission? Because if you go to the board, whoever regulates you, and you just ask, can my 401k own some of my business? I am a licensed person. I own the 401k. Can it own the business? They don't know what you're saying. Here's what the bureaucrat hears. Work. Answer is no.
Yep.
If you're going to ask the question of the bureaucrat, there has to be enough money involved. And this can be. I mean, this can be huge in terms of the money involved. You want to hire the lawyer who knows everyone on the board, the regulators board. He gives money to the campaigns. He knows everyone. He knows how to ask the question in a way that will get you to yes.
Yes.
He's going to buy someone a little bit of booze and they're going to be drinking. And he's going to be like, by the way, I got this situation. No one's going to get hurt. It's this doctor and a tax guy found this thing. And we're not breaking the rules, the spirit. We're just having the guy's 401k on some instead of all him, but it's still him. But you got to
I think that should be okay.
The right person asking in the right time and fashion, but you got to pay that guy. Now, with some more lightly regulated professions, where let's say technically you shouldn't have the licensed activity owned by your 401k technically, but the odds are not that great. And more importantly, if it's fairly lightly regulated, it's one of those where they catch you and they say you're very, very bad, but it's a first offense, no problem, stop doing that. Okay. You see what I'm saying?
Yep.
It depends on the nature of the licensing and how stringent it is and what's the consequence of getting it wrong.
Sure. What about, and I think I know the answer to this too. This is once again that dirty friend. What about if you were to pull goodwill, intellectual property, that kind of thing into the ROBS? I'm assuming that you couldn't do that and then charge a licensing fee over to the S corp.
No, I see. I don't like interaction.
Yep. Okay.
I don't like interaction. I like the silos separate.
Yep. Okay. So you could have it be separate and have just run it through that relative to like what it is you're doing.
You develop IP in these. Look, we've got
Yeah.
guys that set up a ROBS and start writing patents inside of them.
Yep.
They start inventing stuff. They start writing music. I've seen all kinds of that stuff inside of these.
Sure.
Here's an aggressive one. The third bullet point. I have existing clients in my S corp, for example. Their contract ends. I now argue that the new contract is new business and do the new contract in the ROBS.
Yep.
Is that a startup business? Maybe, maybe not. I'd say that's really aggressive. Like, would I sign the tax return? Sure. Would I make the client sign something saying, this is pretty damned aggressive? I can't promise to defend it successfully. You're willing to take the risk. Oh, hell yeah, I'd make him sign that. You could always buy a business from a non-disqualified person. In fact, the franchises, that's what you're normally doing. Like,
Sure.
could you set one of these up and go buy a business owner financed? As long as you're not buying it from a disqualified person.
Sure, it should be fine, right? Yeah.
Oh, yeah, totally.
Yeah.
New locations. I have a dental practice. I'm going to set up a new location. Could I set up the new location in the ROBS? Sure. Sure. So just giving you some thoughts on this.
This is good stuff, man. I like this.
Last slide. Now, first of all, Ashley, I want your people to understand where I'm at politically because I don't think they caught it. You know, I mean, I don't like the commies. I do what I do for a living because I like entrepreneurs. I like to save people. I want the people who earn the money to keep the money. I believe in freedom, economic freedom. I don't like the government having the money because they just it's not even dumb stuff. They do harmful stuff with it, unless it's killing deserving foreigners. I'm all for that. Other than that, a lot of what government does is so harmful. So for me, it's a moral mission. I want to save you money. Here's the good news. Like, if you remember, the IRS leaked billionaire returns.
Yep.
And ProPublica, a bunch of communists, just like Ron Wyden, Senator of Oregon, another communist, they got that data and they started looking at some of the things the rich did to avoid paying taxes, and they try to outlaw it, and not always successfully. So they haven't really been looking at ROBS. They showed up in ProPublica once, and ProPublica was kind of like, it's just a bunch of franchise guys, and half of them lose their money, which, by the way, is true. What's the number one issue the IRS and Department of Labor have with ROBS? People blow their retirement on dumb businesses.
Yeah, I could see that.
That's actually their number one issue.
But right now, Wyden's come after opportunity zones, and he's actually been kind of a chief naysayer on those. And I haven't liked a lot of the stuff that's come out relative to it because I think that it's not necessarily reflective of what's actually happening. But I tell you what, he is pretty sharp in some other things. And even though I didn't like the opportunity zone stuff, I actually got to give Wyden some props relative to, even though he is extremely far left, I actually think that he's actually come out fairly reasonable. So like when the whole thing was going down with respect to the child tax credit and bonus depreciation prior to the election, he was actually a proponent and came out stating that he thought that bonus depreciation was good for America and good for businesses.
That surprises me, but okay.
Yeah, exactly. And I was kind of surprised too. I was like, you know what?
The child tax credit doesn't surprise me.
No, not at all. But
he's a commie. He wants redistribution.
So he was trying to use the bonus depreciation as an offset for the child tax credit. And I actually thought that it was, that's what, politics is all about, like give and take type stuff. Mm-hmm. And I actually liked his approach inside of that. So when I find something redeeming about somebody, regardless of what side of the aisle they're on, I gotta call it out. And so I will call that out on Ron Wyden.
And that's why I'm not in politics, because I understand your approach and it is how it works in politics. Here's my approach. It doesn't always work. I win, you lose.
Yeah. Well, unfortunately, that's the way that it's kind of gotten to. And that's the reason why it continues to kind of really flip-flop.
Yeah, because they're on such extreme sides. You see, when the Democrats weren't insane, I would have been happy to compromise.
Yeah.
But now they're so far out there, it's hard to find. It's nice that you found an exception. Let's put
Do
it
you
that way.
remember? Do you remember the Reagan days when,
Oh,
like,
yeah.
Was it O'Neill? What was his name?
Tip O'Neill.
Tip O'Neill, right? Like, actually, like, hanging out with Reagan.
Yeah.
You know, I mean, dude, that wouldn't happen these days.
No.
And so, anyhow, and
that just reminds me, one of my favorite Reagan quotes was 1981, and the press back then was a bunch of commies and didn't have a sense of humor.
Oh, I know that different from how now.
Yeah, exactly. So he said, he was on a hot mic, but I think he was sharp enough to know that it was not an accident on his part. He pretended it was.
Yep.
He goes, well, we've outlawed the Soviet Union. Bombing starts in 5 minutes. And they went nuts. They went nuts.
That's hilarious. and which promptly led to the Soviet Union freaking out. I mean, dude, they were not.
I think even they're like, we make fun of the gerontocracy, but we have it now, our version of the Politburo. But even the Politburo guys were probably like, duh, Sergey, that was a good one. This Reagan has a sense of humor.
Yep.
So
all right, guys, here we go. Here we got
you talk.
Here we got the QR code for the event, which is down in Hotlanta, September 26th to 28th. And if you click the QR code, I actually think, and if you go to the thing we got in the banner too, will actually get you to this registration site. I am going to be down there trying to navigate through like what it looks like. I got kid issues and stuff like that I'm trying to deal with, but looking forward to seeing everybody in person. I think this is going to be an awesome event. Once again, every time I'm with Hyre, whether it's in an event like this or whether I'm in an in-person event, I learn something new. You will too. Get signed up for the event. We're super stoked about that. Also, as we're talking about events, we are going to be handling, and this is another thing, and Hyre, you and I need to talk about this. I'm actually speaking at the Madison Insurance event, which is another really cool way to be able to drag ordinary income out of an existing business, tuck it into a segregated account down in Puerto Rico, not have any claims, or, be able to utilize it for insurance for potential future claims. When you don't use that money, to have it grow tax-free, and then to be able to take it out tax-free on the back end, utilizing the 10% inside of your qualified opportunity fund. And we're going to be hitting that. That is November 13th through the 16th down in Puerto Rico. So stay tuned. We'll get you details on that so that we're going to come down and we're going to visit you. We're going to crash your place, Hyre.
Sweet. Come on, dude. I can accept a few party goers.
That's right, man. I tell you what, I do remember very well going to the place that was over there by where the cruise ships are.
Yeah.
Those were some mean old fashions. I actually had a non-alcoholic old fashioned the other day, and it didn't taste sacrilegious. It was actually fairly decent. That's what I miss. I actually really miss old fashions.
I did like them. I don't.
Yes.
I don't. Who are you?
All right, guys, we are way past time. We tried to do this in an hour. We should have realized that it was going to take us 90 minutes. We're coming up on that as well. So hold on. Let's see. We got one more final question in here from Terry. Can the owner who owns, let's say, 5% of the C Corp also be eligible for QSBS?
Oh, yeah.
Yeah. And I mean, I'll tell you what, if you're worried about QSBS on a 5% holding, you hit a moonshot on that deal, which would be awesome. And I think that covers the final question that we got in here. Could QSBS and Robs work together? The answer is yes. So once again, everybody, thank you for participating. Thank you for the folks in the chat. Thank you, John, for being here today. We're super excited about seeing you in Atlanta. Once again, click that QR code, get signed up, and we'll see you in the ATL. Any final thoughts, Hyre, before we get out of here?
Just doing what Ashley does in a different way, helping you keep what's yours.
That's exactly right. We are truly passionate about that, about helping people do well by doing good. So once again, click the QR code, click the link, and we'll see you in person in ATL. This is John Hyre and the OZ Sherpa out.
Hasta la vista, baby.